Well, we are now 1 week before Thanksgiving, and we got some big news last week. Trump administration is considering a 50-year mortgage. Wow. So we'll see if that happens. There's been a lot of critique and criticism and interest in the 50-year mortgage over the last week. But what is it? How would it work? And is it a good thing for consumers? So this article does a good job kind of outlining the 50-year mortgage, but I think the charts at the bottom are really going to highlight what it means for consumers. So, as you may know and expect, shorter loan terms are typically a better deal for borrowers because they get a better interest rate and they pay down the loan principal faster. We call that amortization. So, the longer you stretch that out, then you're going to pay a lot more interest to the bank and it's going to take a lot longer to pay off your loan, hence the years. So, here was an example that they pulled together. So, let's say after putting 20% down, you end up with a mortgage of $341,000. Okay, so this is assuming you either did it with a 15-year, a 30-year, or a 50-year mortgage. So here's what it looks like. After 10 years, on the 15-year, you're going to pay the lowest interest rate because typically you're going to pay a lower rate the shorter your loan is, and you're going to pay a higher rate the longer your loan is because it's riskier to the lender, the bank. So the 15-year, you're paying 5.6%. Your payment is the highest. It's $2,800 a month, and that's just principal and interest. But after 10 years, you will have gained $194,000 in equity by paying down that much of your principal on that $341,000. So you paid off more than half of it after 10 years on a 15-year mortgage. You're almost there. On the 30-year, you're paying a little higher interest rate, and this is the typical product that most buyers, 90% of buyers, are typically on a 30-year fixed rate, whether it's FHA, VA, conventional loans, jumbos, doesn't matter. 30-year is the standard today, but you're paying a little higher interest rate, much lower payment. So now you're paying just under $2,100, and you will have paid off after 10 years, $54,000 of that mortgage. So not nearly as much, but you made some gains. If you move it to a 50-year, now you're paying 6.8% interest. You're paying the highest amount of interest. And after 10 years, you've only paid off $11,500 of the principal of that loan. Almost nothing. How much money did you really save? Well, according to this, if it's $2,091 minus $2,002, you saved $89 a month. So was it worth it to save $89 and now you've lost $43,000 in principal? I'm not a big fan of the 50-year mortgage. We'll see what happens. The other reason is home values are priced to 30-year mortgage payments. So if you add something that, let's say in theory, reduces mortgage payments, all it's going to do is inflate housing a little more. I don't think it helps things really become more affordable. What I am interested in is this little subtitle here. They're also looking at assumable mortgages. This means you could say, hey, buyer, you can just take over the rest of my mortgage. I think that would be interesting. We'll see what happens there. Where are mortgages today? So we're looking at the 30-year fixed rate mortgage right now, about 6.38%. You can see the smaller mortgage, the 15-year, is about 5.86%. So if you added a 50-year in here, again, I think per that example, you'd be in the high sixes, maybe even 7% on a 50-year mortgage. All right, well, you've heard about the K-shaped economy. That means the upper class is going up while the lower class is going down. So it's kind of creating a K. It's separating them. Well, here we go. Number of first-time home buyers hitting a new low, yet all cash buyers hitting an all-time high. Can't explain a K-shape better than that. So here's the chart. Share of first-time home buyers sinks to a new low. This is way back in 05 right here. This is 09. 2010 was 50%. Why? Because the housing collapsed and now it made it easy for everybody to get in there, buy cheaper homes. Since then, it's just come down, down, down. Now 21% of buyers are first-time home buyers. That is an all-time low. And this chart goes all the way back to 1981. But if we look at cash, look at that. Now it's up to 26%. You go back to 04, it was like 7, 8, 9. It barely clipped over 10% back in 2010. Now it's up to 26% of buyers buying all cash. All right, this one is going to hit hard for Austin. So high income job losses are cooling housing demand. Well, what markets have high income jobs? Well, this chart's going to show it to you, and I know it's going to be hard to see it here, but basically green is good, yellow is kind of growing slower than normal, and red is actually shrinking. So the stronger markets are are a little more on the high end. But here's Austin down here. And you can see the only green that we have is government. So government's the only one that is still growing. And we are mostly red as we go to the right, which includes high tech. And so here's what it says about Austin. It says Austin and Denver are growing much more slowly than their historically strong employment trends, which typically are 2 or 3%. So we're growing slower. Tech and professional service jobs are declining in both markets, and even healthcare, which is expanding in most metros, show weak growth here. This reduction in high paying jobs is weakening demand for both home purchases and rentals. And if you've been following all these videos, you know that in the data. All right, here is what we're seeing on that. So again, you've seen this before. Again, we're leaning towards a buyer's market. Depending on what segments you're in, it's a strong buyer's market. Other segments are kind of balanced, depending on the zip code and the price point. But again, look at supply. We're at the highest amount of supply we've had in over 10 years. And we are at the lowest demand we've had in 10 years. So higher supply, low demand means it's going to take longer to sell properties. All right, here's what we look like as a historic sales price trend over the last 10 years. So this is pre-pandemic, nice and steady, just bouncing up the stairs, right? So nice and steady growth. And then you had the pandemic, and then it shot up the market like a rocket with the cheap debt and all the government stimulus. But ultimately, it just overpriced us. If you really follow this line and pretended that never happened, maybe we'd be approaching high threes for a median home value, maybe getting to 4. And right now we're about 440. So we are still inflated over the long-term trend. We are starting to go sideways. And I think what's going to happen is, my prediction is, we are going to stay kind of bouncing sideways until the longer term appreciation trend catches us. When is that going to happen? Don't know. Could be next year, could be in 27 or 28. But I think that's what's going to happen is we had to come down, and now we're going to ride sideways until we can get back to this long-term affordable trend for buyers. All right, finally, here's where we are on inventory. This is single family homes. You can see it steadily coming down, should continue to do that until we get to January. January is where you see it kind of start to bounce back up. But right now we're sitting at 13,000 homes. If I go back to last December, we were at 10,400. So we're going to end the year higher by a decent amount than we did last year. So we're going to start next year with a higher supply than we did in 25. And so until more buyer activity comes back into the market, and or pricing and interest rates kind of all collide and create a better stoop, what's going to happen is, until we get buyers to start pulling that inventory back down, we're just going to continue to build up supply until we get that demand. So next year, I predict we're going to be starting at a higher level. January last year, we were at 10,600. We might be at 12,000 starting the year when we start 2026. So if you're a seller right now, look, we're in the home stretch of 2025. There's probably only a couple weeks left for buyers, unless they're cash buyers. There's only a couple weeks left for buyers that want to close in 2025 to write offers with a loan and close in December, ideally before, a holiday season. So we're going to start to see some of the listings come off the market as withdrawns. They might reset and plan to list sometime in the middle of next spring. You'll see some properties close. And then you're going to have kind of a pretty large group of sellers here heading into the holidays. And we're going to have to see how that mixes with buyer activity. If rates can come down a little bit, we might see some more buyers maybe try to get a jump start on 2026. But I don't predict we're going to see a decent amount of buyers until we get to maybe late January or February next year. If you're a buyer right now, I've said it before, I'll say it again. Things are kind of in your favor right now. You have more sellers than competition. Rates are at their lowest point that we've had in 3 years. And again, you're going to have a window until we get back over here. When the buyers and the new listings kind of come back to the market, you'll have an opportunity to negotiate with the current sellers. Anyways, hope this video was helpful. Make sure to watch our videos each and every week. We'll have them on my YouTube channel at Ryan Kelly Group. And of course, if you know somebody looking to buy, sell, invest, or finance here in Austin, would love the opportunity to chat with them. We're actually going to have a warm week this week, heading towards Thanksgiving. We'll see how it goes, and I'll talk to you next Monday. Thanks.